And go ahead and put the textbook up. And unfortunately, we always have to keep our fingers crossed as I go into tablet mode. Looks like we survived that. Okay. No, not quite. Not quite. Didn't quite survive it. Okay, let's try it again.
Hi, Professor.
Hello.
I just wanted to let you know I received my books like yesterday.
Oh, did you? Oh, good.
Yeah. I don't know if anybody else in the class did, but mine came. So
Oh, okay. That's good
Hello,
news.
Prof. I also have received my book yesterday night. I got
Okay.
it.
oh,
All right.
good. Like everybody's getting their stuff.
Yeah, good. Then that gives me cause to reach out to my contact, saying, where's my books? So I'll give them a little while longer though. Hopefully by next week they have them. Okay, excellent. Thanks for the update. Let me try again, tablet mode. Here. Okay, should be okay now. Okay, good. Okay, I don't know why. It seems like some sort of like weird ritual we have to go through every time and close the thing, open it again. But anyway, we're okay now. Okay, so what we're gonna do, remember when we started chapter 3 last time, I made the point that we're sort of walking through the balance sheet at this point, the next couple of chapters. We talked about cash and accounts receivable, notes receivable. So current assets, continuing with the current asset inventory. Then we will look at fixed assets, look at depreciation methods, and then finish up talking about accounting for intangible assets. So pretty straightforward stuff here in these chapters, but it's good for us to review some of these things and be ready to do a good job on our exam and get through our homework and stuff. Now, on the FAR section of the exam, we're really talking about retail inventory. We're not talking about entities that manufacture inventory and therefore have raw materials and direct labor and manufacturing overhead and work in progress and finished goods and all that stuff. We'll worry about that when we get to the bar. If you're going to take the bar exam, it used to be on the BEC section. Now it's on the bar exam. By the way, you may want to stay alert that there's going to be a new course here at Golden Gate, Accounting 381, that we'll be offering next term, which will be the business accounting and reporting section of the exam. If you plan to take that discipline, it may not be a bad idea to go ahead and enroll from FAR over to BAR, since there is a connection between the material that's contained in FAR and goes in BAR. Audit accounting 380 for the auditing section, you may have noticed, is already on the schedule, or whenever they release the schedule, it'll be there. BAR, since it was a new class, we had to jump through some administrative hoops, but it should be there quickly if it's not already. And that'll be accounting 381. Okay, now on the FAR exam, when they ask questions about inventory, okay, it's really 5 different things that they ask about. One, they want to know, do you know what items physically should be included in inventory? The second thing they're going to want to say is, well, how should you value inventory? And it's typically cost, unless what? Unless that value of that inventory falls below its cost, then we're going to have to mark it to the lower amount. Once we've determined how to value the inventory, then we're going to start to take a look at, well, what would be the value of inventory under the different cost flow assumptions, FIFO, LIFO, weighted average, moving average, a couple of different smaller, less used inventory methods. For example, we'll talk a little bit about dollar value LIFO here in a little while. And then finally, do you know how to account for inventory under the perpetual versus the periodic accounting systems? So that's really where we're going with our discussion about inventory. So starting out, talking about what items should be included in inventory, and we right away start talking about goods in transit. Okay, now you are well aware of the terms free on board shipping point versus free on board destination. Okay, if we have free on board shipping point, generally the seller will pay the freight, the seller pays the freight, and title shifts to the purchaser as soon as those goods are delivered to the common carrier. In other words, as soon as they get on the truck. Okay, so I think you probably know that, but let's go ahead and flashcard some key things about free on board shipping point. It is a sale when shipped. Okay, considered a sale to the seller when shipped. Okay, when shipped. And then the other thing that you should put on the flashcard, okay, on a flashcard, is these items should be excluded from sellers, and I'm going to put EI here, and they should be what? They should be included in buyer's ending inventory. Okay, even if the buyer hasn't taken physical possession of that, legal title has passed at the time the goods are handed to the common carriers when they go on the truck. So even if we're here in San Francisco area, and if the truck's still in Kansas City, let's say, I would still act as though I had received those goods because title has passed, right? That's free on board shipping point. I think you've known that for a long time. Okay, now if it is free on board destination, title doesn't pass until the buyer actually receives those items. Okay, so now some key points to flashcard. No sale when shipped. Okay, and then the other flashcard, how to deal with those things, they would what? They would be included in sellers ending inventory and excluded from the buyers ending inventory. Okay, so some basic, very basic things. I mean, I think you probably learned all that in your accounting 1A class, but let's just go ahead and flashcard that. I don't know why I always get those flipped in my mind some reason, even though I've been looking at accounting or going on over 40 years now, and yet somehow I still get those flipped in my mind sometimes. So make sure and flashcard that, okay, so that you have it easily remembering that. Now, when we talk about consigned goods, what happens here? Let's say you write a book and the title of the book is Mothers Don't Let Your Children Grow Up to Be CPAs, right? Okay. And so what happens? You take that book to, Barnes and Noble, and you say, yeah, I want to really, have you buy this book from me, include it in your inventory and sell it. And Barnes and Noble says, I don't know. I'll tell you what, they take pity on you. They say, you can leave the books here. We'll let you have a display over here. And then if somebody buys the books, we'll retain 1% of the sale price and we'll remit the rest of the money to you. Okay. In that situation, you would be the co-signor and Barnes and Noble would be the co-signee. Now, if something happens to the books, they get stolen or something, you suffer the loss, not Barnes and Noble. And so what happens? Since that's the case, Barnes and Noble would exclude, they would be considered the co-signee, they would exclude those items from their ending inventory, and you would include them in your ending inventory, even though they're on somebody else's premises on Barnes and Noble store. Okay, so include in co-signor ending inventory, exclude from co-signee, which would be Barnes and Noble in this example. Okay. Okay, some very basic things that I think but let's just go ahead and flashcard those just so we don't have to keep reminding ourselves of the things. We have them on the flashcards and then we memorize that and we're in good shape when we come to deal with the exam. Okay, good. Now, valuation issues. Okay, an inventory is valued at cost, what you paid for it, unless that value falls below its original cost, then you would write it down to a lower amount. Now, let's just look at freight charges. Okay, and when we talk about freight in paid by purchaser paid by the purchaser is included in inventory cost. Any money that a company pays to secure an asset so they can use it in their business is part of the cost of that asset. So the buyer is paying the freight on that. We call that freight in, and that's part of the cost of the inventory. Okay. Now, freight out is paid by the seller, and that is a selling cost, selling and administrative cost. In other words, it's expensed as incurred. Okay, so make sure and flashcard that freight in, that term, that means that the buyer paid, that's part of the cost of the inventory. Freight out is paid by the seller. It's a selling cost, it's expensed as incurred, right? Okay. All right, now there are exceptions from the lower of cost or market approach to inventory. Okay, so 3 exceptions from cost principle for inventory. And one is right here. Okay, so let's just list these. Number 1 is going to be precious metals, farm products. If you are in the business of selling, gold, okay, they allow you to carry that inventory at its net realizable value because gold has a readily determined market, however much per ounce. And so they say, hey, you can just carry that at net realizable value. Now, when we say net realizable value, which is its market value less cost to dispose, if you had some shipping charges, I don't know, you got to get the gold from the gold wherever they get it, gold mines or whatever, to, you know, where you can sell it, then you would back that off of the market value and report it at net realizable value. Okay, so that's the first exception. Now there are 3 exceptions. Okay, so let's just go ahead and see page 24 for exceptions. Really? Are you really gonna do this to me? It gets ponderous. Just a second, guys. Okay, see page 22 for the other 2 exceptions. I'm not going to try to write there because I think when I try to write too close to the margin. Okay, and here's exceptions 2 and 3. Okay, and you don't have to write inventory down to its lower market value. Okay, you can leave it at its cost if the subsequent sales price at the end of the period is not affected by its market value. For example, let's say you have a warehouse full of steel and you're going to use that warehouse to produce vehicles or something, and the price of steel is dropping. Well, if it's not going to affect the price of cars, then you don't have to write that inventory down. Or if you have a firm sales contract, so something selling for, you know, $4 million, originally was at 5 million, but you already contracted with me that I will buy it for 5 million, then you don't have to write it down to that lower 4 million. Okay. All right. So those are the 3 exceptions, okay, to the lower of cost or market. Other than that, we should carry inventory at, and it's either going to be, I keep saying lower cost or market, but it's either the low cost and net realizable value for every method of accounting for inventory except LIFO. And then we're going to take a look to see with LIFO, we use lower cost or market, and we'll see how that works. Okay. Now, when you have to write inventory down, you take the loss in the current period, and generally it is included in the cost of goods sold. In other words, you would credit the inventory to write it down, and you would debit the cost of goods sold to write it down. Okay, now if it is material, then you could have a separate line item on the income statement saying loss from, you know, devaluation of inventory if it's a very large amount. Okay, now it is no reversal allowed. Once you write inventory down, it stays down. Now you come over and you take a look, and let's just take first the look at lower of cost or market. Lower of cost or market, lower cost or net realizable value, and it's used for all methods other than LIFO. Okay, so all we do is we compare the cost of the inventory to its net realizable value, and the net realizable value, as we've already seen, is whatever its market value is less any cost to complete. Okay, so we'll compare that to the cost. And if that net realizable value is falling below the cost, we write that inventory down to its lower cost. And we use that approach for every method except LIFO. And we'll talk about LIFO here in a minute. Now, when we look at inventory, okay, we can do the analysis for the lower cost or market by the entire inventory. We could do it by a major category of inventory, or we can do it by single items in the inventory. Okay. Now it turns out that the single item approach is the most conservative. Okay, so go ahead and flashcard here. What I really wanted you to flashcard is single item approach is most conservative. What happens is if you're, say, using the entire inventory, some items go up, some items come down, and so they tend to balance each other out, right? Whereas if you're sitting there and you're doing it item by item, you don't have something going up compensating for something going down. And since each item maybe tends to go down, this single item approach will give you the lower value of the inventory. Okay. Now, under lower cost or market, which we only use for LIFO, okay, and we use LIFO, and guys, I know, or the retail inventory method, and I know that, you know, when we call out US GAAP, that gets a little distracting for you because then it makes you think, are we studying anything other than US GAAP here? And the answer is no. There is no international financial reporting standards on the CPA exam any longer. Okay, so even though they're calling out US GAAP here, it really wasn't necessary. Okay, and basically what we will do is we will come up with a market value. We'll compare that to the cost. And if the market value is below the cost, then we will write it down to that lower market value. Now, what happens in evaluating market value, okay, we are going to be given a replacement cost, and then we will have to compare that replacement cost to the market ceiling and the market floor. And if the replacement cost is not over the ceiling, not below the floor, we'll use the replacement cost. If the replacement cost is over the ceiling, we use the ceiling. If it's below the floor, we use the floor. So a good way to sort of just summarize that or just quickly remember that on your exam is to always use the middle amount between the replacement cost, the market ceiling, market floor. Now, what you need to flashcard here is what is the definition of market ceiling and market floor. That's where I used to struggle with these questions. I understood the concept, take the replacement cost, compare it to the market ceiling, market floor. If it's not over the ceiling, you can use it. If it's not below the floor, you can use it. If it's over the ceiling, use the ceiling. If it's below the floor, use the floor. And I could get that, but I could never figure out how to calculate market ceiling or market floor. I couldn't remember how to do that. So once I flashcarded that, then the questions became easy. Market ceiling is a net realizable value. The same thing we were using for lower cost or net realizable value for methods other than FIFO. You simply do what? You simply take what it's selling for minus what? Minus any cost to complete and dispose. That's the net realizable value. That's the market ceiling. You can't have the inventory, assuming that the cost is more. You can't have the inventory being more than that amount. Okay. Then what happens if you have the market floor? You have to take the market ceiling minus a normal profit. And again, that is used to make sure that when you report replacement cost, it's not below the floor. Okay. Now, flashcard that, but we're going to practice with that right here on this. And I think once you kind of go through a couple of these practice items with me, you're going to see that this is, you know, it sounds harder than it is. Okay. So what happens? Here's the cost. Okay. And we see for this item one, we see this cost is $20.50. Okay. Now we look at the replacement cost. And when we look at the replacement cost, we see, it's 19. So we know we're going to have to write the inventory down because what? The replacement cost has fallen below the original cost. But we have to evaluate the replacement cost to make sure it's not over the ceiling and not below the floor. So we take the selling price minus cost to complete. I'm going to put a little C there for ceiling. That means that my ceiling now is what? 24. Then I go ahead and I take off a normal profit off of that net realizable value, that ceiling. and I get what? I get 18 is the market floor, okay? So now when I look at the replacement cost, I can see, oh, okay, great. It hasn't fallen, it's not above the ceiling, it hasn't fallen below the floor, so I can use the replacement cost. Okay, I'm just seeing the solution down there. Let's try another one. Okay, let's look at number 2. Number 2, the cost is 26, replacement cost is 20. Okay, I know I'm going to have a write down here. I go ahead and I take 30 selling price minus the cost to complete. So the ceiling I'm seeing here as 28. I subtract the 7. So that means the floor now is 21. Uh-oh. Now I have a problem because what's happened? The 20 has fallen below the floor. So I will now do what? I will now report that inventory at the 21 at the floor. I'm just pointing this solution to you. Question. Okay, now if it's net realizable value, then that gets a little bit easier, and that you simply have that one calculation. This is for everything other than FIFO. Excuse me, everything other than LIFO. FIFO would use this approach. And now I just come up with my net realizable value here. And this first one is 27. The cost is 28. So I'm going to report it at the 27. Okay. Question. All right, good. Key thing to doing well on those questions, guys, is to make sure you know the definition of ceiling and floor, and then you're in good shape. Okay, now you come over and periodic versus perpetual method. Okay, now I'm going to advise you to make a flashcard of this approach to inventory, because on the CPA exam for your periodic method, of course, but also there may be other questions where they may ask you, well, the inventory records were destroyed, and what was the beginning inventory or something, and you'll have to work upwards to get to it. So flashcard this. You have to know this well. Beginning inventory plus purchases equal goods available for sale minus ending inventory equals cost of goods sold. I always think of, the Catholic priest, right? Beginning inventory plus purchases equals cost of goods available for sale minus ending inventory equals cost of goods sold. You need to just be able to rattle that off. So flashcard that, okay? Now what happens is we don't really know what the ending inventory is until we physically count the inventory. Now, this is back in the olden days before we had these things that automatically scan things, and we know what's in our inventory. You get a box of stuff, you scan it all into your system, and then when you sell the stuff, the cashier scans it again, and the stuff goes out of inventory. So most companies these days will probably use perpetual, and the inventory records are updated after each purchase of inventory and after each sale. So at any point in time, the inventory count should pretty much reflect what's out on the showroom floor or whatever. Perpetual systems traditionally were used for very large items, but nowadays almost most companies would use the perpetual method. Okay, now let's go ahead and let's take a look at a comparison between the two methods. And I'm going to start down here with perpetual because I find it a little harder to follow this example. If you do example 3 first, I have trouble with the notion of selling inventory before I buy it. So I'm going to buy the inventory under the perpetual method. And when I do, I debit inventory. I credit cash, accounts payable, whatever it is, right? Then what? Then later on, I go ahead and I sell that inventory. So I debit accounts receivable, cash, okay, whatever, credit the sale. And of course, I'm going to sell it for more than I paid for it. And so since I've sold now 100,000 of that inventory, I debit cost of goods sold, credit inventory. Now, under the perpetual method, if we're looking at our inventory account right now, it's what? We debited it for 3. We just credited it up there for 100. So we post that. Okay, so obviously the balance in here is what, 200,000, right? With me so far. Okay, now what happens now under the periodic method? I don't debit the inventory account after I purchase the inventory and credit it after I sell it. No. Now what I do is I debit purchases when I buy the inventory. Okay, debit purchases when I buy the inventory, credit cash, and then when I sell the inventory, I don't update the inventory records. I'm not going to update the inventory records until I count the inventory at year end and go ahead and see what's left, and that's how I'll update the inventory account. Now, just to sort of see how that would work under the periodic method, though, let's go ahead and expand on this example. And I'm going to pretend like this company just started business. So the beginning balance of the inventory, okay, we're going to analyze the inventory account. Beginning balance is 0. Okay, then what? Then I'm going to add the purchases. And the problem, the example told me the purchases were 300,000. So my goods available for sale are 300,000. Then I'm going to go ahead and count my ending inventory. Okay, now I'd have to physically count it, but we're sitting here in classroom, right? But I know from the peeking at the perpetual information that 200,000 is the correct balance for the ending inventory, but I'd have to actually count that. So since 200,000 is what I count as being left, then the cost of goods sold, right, is 100,000. Okay, so that's how that would work. And then what you would do, of course, is you would go ahead and debit inventory under the perpetual method for 200,000. You would debit cost of goods sold for 100,000. And you credit purchases. Okay, purchases isn't an account that we list on our financial statement. Purchases, I know you see it in textbooks when they're trying to show you how they got cost of goods sold. They'll show right on the face of the income statement, beginning inventory. Companies don't do that. They're just going to report cost of goods sold, and they would eliminate the purchases account at that point in time by crediting it. Okay, good. So we've understood some things about the items to include in inventory, the valuation, what we do with our transportation costs, okay, lower of cost or net realizable value for everything other than LIFO. LIFO, we use lower cost or market. We understand something about the perpetual versus the periodic method. Now we're going to start to talk about cost flow assumptions. We're going to talk about FIFO, LIFO, weighted average. Those are the 3 most tested methods on the exam. And then we'll talk a little bit about some other lesser tested methods like dollar value LIFO, gross profit method, some of those things. Okay, good. So let's start with first in, first out. Oh, before I forget, you are not supposed to tell me what was on your test. No candidate is supposed to call me after they took their test and say, here's what was on the test, okay? However, I sometimes have a dream that students come to me in my dream and tell me what was on the test, okay? And in my dreams, I have heard that there is a task-based simulation in which the examiners ask you to calculate ending inventory and cost of goods sold using FIFO, LIFO, and weighted average. So we're going to practice with some of that here and spend a little time with that here because of that dream I had. Okay, so let's just go ahead and let's just use an example. Okay, let's say we're Safeway, whatever, and you go to Safeway and there's a milk fridge back there. Okay, and here you come with your shopping cart. Okay. And then you come up and you have the freezer, and you have some milks that were bought on 10/1, and those cost Safeway, say $4.25 per milk, whatever. Okay. And then you have some milks in the freezer. This is a freezer. Okay, but I'm not a good artist, but I'm going to do it anyway. On 10/15, okay, there's some milks, and Safeway paid $4.50 for those. And then there's some that they bought on 10/31, and Safeway paid $4.75 for those. Okay, and those are the ones that were most recently delivered off the big old Safeway truck. Does Safeway have a good distribution system? You bet you they do. They'll run over you if you get in their way. Okay. All right. So what happens? So those were the milks that were delivered. And under first in, first out, the idea is that what? You're going to grab those and you're going to put those in your cart. Okay. So the cost of goods sold is going to be valued at those 425 ones. The what? The ending inventory is going to be valued at what? At those 475 ones. Okay. Now, I know you know this, but when I'm first teaching inventory methods to students, they say, well, aren't the milks going to get rotten that way? Or, they have these different questions. And I'm like, guys, it has nothing to do with the actual flow. A company gets to choose what method they want to use, even if they're goods. Most goods flow FIFO, but it doesn't matter. Safeway in this example could have used LIFO if they wanted. They get that choice. Okay. Now, you come in and let's just take a look at this passkey and let's flashcard this. In periods of rising prices, FIFO method results in the highest ending inventory, right? That's what we have, period of rising prices. The lowest cost of goods sold, yep. And what? And the highest net income, okay? Because what's happening? Let's say the sales price on these milks are $5. You're taking what? The cost of goods sold here at $4.25. So your gross profit is what? 75 cents. Meanwhile, to replace those milks, it's really going to cost you what? $4.75. Okay. So let's go ahead and take a look at something here. And ending inventory includes most recently incurred cost. Okay. Thus, the ending balance approximates the replacement cost. Flashcard that and flashcard that as a FIFO advantage. Because sometimes the exam will ask that concept in the idea of, well, what is an advantage of FIFO? What we're reporting in inventory pretty much reflects what it is that we're going to have to pay, okay, to replace those. Now, ending inventory cost of goods sold are the same whether we use periodic or perpetual. So we're going to have the same number regardless of periodic or perpetual for our cost of goods sold and our ending inventory. So you can flashcard that, okay? And then flashcard the highest net income. Okay, I've already asked you to, no, I didn't ask you to flashcard that passkey. So flashcard, but the other thing I want you to put on the flashcard is this is somewhat of a disadvantage of LIFO because we're getting a little bit of an income statement distortion here because it's showing we had a gross profit of 75. Meanwhile, that profit's going to be going away pretty soon as we start to, sell those items that have a higher cost. Okay. Okay, good. Now you come over and let's just go ahead and take a look at this example. Okay. And this could be an example of a task-based simulation. in which they're going to basically ask you to calculate the cost of goods sold and the ending inventory, and you're going to have to do it for both perpetual and periodic. Okay, so let's read through the fact pattern here. It's the first year of operations. They purchased all their inventory in 3 batches. Batch 1 had 4,000 units. Those cost $425. Batch 2, they purchased 2,000 units that were for $450. Batch 3, 3,000 units at $475. They sold 4,000 units, 3,000 units after the first purchase, and 1,000 units after the second purchase. Okay, now you take a look, and let's just sort of use this table to remind ourselves of what went on. They bought what? They bought 9,000, sold 4,000. So there's still what? 5,000. I'm just going to write it down here in ending inventory. Okay, good. Now what happens? Since they sold 4,000 under FIFO, these are all gone. They sold all those. Okay. And the 5,000 items left in inventory, 2,000 of them are valued at $450, and 3,000 of them are valued at $475. That gives me $23,250. I do what? I go ahead and subtract the ending inventory off of the goods available for sale. That's what that number is, right? Beginning inventory was 0. And that gives me 17,000. I've answered the question, cost of goods sold, ending inventory. Okay. Now, if I use perpetual, I'm going to come up with the same number. In fact, if you got a question and they asked you, calculate the ending inventory for FIFO under periodic versus, versus perpetual, that'd be an easy question for you because you only have to calculate it once for either method you choose. And then you've got the answer to both of them. Okay. But let's just go ahead and look at this. So the inventory items come in, okay, 4,000 at 425, 17,000 come in. You go ahead and you sell those and you value those ones that you sold at 425. So you're going to credit the inventory, 12,750, debit the cost of goods sold. Okay, I'll just go ahead and put the credit and debit in there. Okay, then what happens, because we're using the period perpetual now, then you bring in the new items, debit the inventory, credit cash, whatever, those come in at 450, and then you assume that you sold another 1,000 and you use what? You use that 425 price because there's still 1,000 of those. We start out with 4, we sold 3, we still have 1,000. We use that 425 price, we credit the inventory, debit the cost of goods sold, and then we bring in the new ones. And again, you get the same answer because you assume that you sold those 4,000 ones all at 425. Question. Okay, now weighted average. If you get this question as a task-based simulation, my advice is that you do the weighted average one first, then you do the FIFO, save the LIFO for last. Because FIFO, you get a 2-for-1, if they ask you both periodic and perpetual, you get a 2-for-1 advantage there, and then you just get to, use the same answer for both periodic and for perpetual. But I would do weighted average first because it's the easiest. You take all the cost from the 3 batches, you divide it by the total number of units. That gives you the cost per unit. Okay. And then you just go ahead and you do what? You multiply the cost per unit by the number of items in the sold and the number of items in ending inventory. Very simple. And there's no, perpetual versus periodic here. Okay. Now, moving average. Okay. Moving average, I don't think they'll ask you in a task-based simulation, but you might get 1 or 2 questions. Okay. And under moving average, okay, basically we're going to recalculate the cost per unit after each purchase. Flashcard that. And we must use perpetual. Flashcard that. Okay, now let's just look at this moving average. Now, when the items first come in, obviously the average cost is $425. Those are the only items we have. We sell those 1,000 and we're going to bring those out at what? At $425, because that's the only cost we have at this point in time, right? So we go ahead, excuse me, we sell those 3,000. We're going to bring those out at $425, and we still have 1,000 in there at $425. But then remember, we bought 3,000 more, okay? And so those came in at what? Those came in at 9,450 times the 2,000. So we take what we had in there, those 425 ones plus the 450 ones. That gives me, you know, what does that come out to? 4,250 plus 9,000. Did I write that number down somewhere? What's 4,250 plus 9,000, guys? Everybody got that? 13,250, I guess.
13,250. Yeah.
Yeah, 13,250. I don't know why I need to do that. It's just a nerdy thing here. And you divide that by what? The 3,000 units, right? The 1,000. Oh, come on. You divide that by the 3,000 units, that gives me now a new moving average cost per unit. And when I sell those next 1,000, okay, those come out at what? At that 4.4167 amount. And then when I bring in those next 3,000, okay, those come in at 14,250. I add that to what was left, and I'm just going to go ahead and spare you having to add those two numbers together. That's now divided by the 5,000 units left. You have a new moving average cost, and then the next sale would go out at that price. On the CPA exam, they'll probably only make you go through one cycle of calculating the new moving average. They're not going to make you do it a couple of times. They're not going to turn it into a simulation. Question. Okay, there's that number. 23,083 is that number right there. Okay, all right, good. Now you come over and let's take a look at last in, first out. Okay, now last in, first out under LIFO. Okay, the first cost, the last cost inventory, the first cost transfer to cost of goods sold. So let's just do a little visual down here since we have some space. Okay, I think you know all this, but let's say this is like a pile. I went one time to have some landscaping done, and I wanted some decorative rock put in my backyard. And so the guy said, well, you got to come with me to the rock piles to pick the rock that you want. And it was like, why? And I guess, you know, they had the experience that they put some rocks in some people's backyard, and people said, I don't like those, man. Take them all out. Can you imagine? So no, you got to pick them. So I says, okay, fine. And when I'm there, you know, accountant nerd, I'm like, oh, LIFO inventory. Oh, they're like, huh? Okay, so what happens? You come over, and when the rocks are delivered, that's a delivery truck, believe it or not. When the rocks are delivered, they come and they dump them on top of the pile. Now, when the customer comes and picks those up, you know, they don't sit there and say, hey, knock down the rocks. You know, I need to, you know, get to those ones on the bottom. They just go ahead and they do what? They just take off the top of the pile. Okay. Now, again, Safeway could have used LIFO. Okay. It doesn't have anything to do with the actual flow of goods. A company can just choose it. I'm just showing you an example, which that is the actual flow. Okay. Now, what happens? So under LIFO, ending inventory is these 425 ones. Cost of goods sold is the 475 ones that, you know, the landscaping company, whatever, is putting into their truck, right? Okay. So if the rocks were selling, you know, for $5, whatever, per pound or however you value rocks, you know, $5 minus what? Minus 475. Now my gross profit is what? Now my gross profit is 25 cents, right? Okay. So let's go ahead and let's just take a look at some of the things that they tell us about LIFO. Okay. And so we say ending inventory includes the oldest cost and will typically not approximate replacement costs. Flashcard that as a disadvantage. Of FIFO. That's a not FIFO, but LIFO. That's a disadvantage of LIFO. Okay. LIFO does not generally relate to the actual flow of goods. Another disadvantage. Put that on the flashcard. Got a couple of disadvantages, okay? If LIFO is used for tax purposes, it must be used for the GAAP financial statements. Flashcard that's not really an advantage. Disadvantage, it is called the LIFO conformity rule. And this was one of the main reasons that the US companies didn't want to go over to IFRS, because IFRS does not allow the use of last in, first out. And so if companies couldn't use it for GAAP financial statement purposes, they couldn't use it for tax purposes. And what happens if you have lower income under LIFO, right? The 425 versus 475, you get paid less tax. And so companies were throwing a fit. Wait a minute, we can't use LIFO because we want to use it for tax purposes because we get a lower tax bill, right? And so that was one of the major sticking points as to why the US never went over to IFRS. Now, let's look over here. The use of the LIFO method generally better matches expense against revenue because it matches current cost with current revenue and eliminates holding gains during periods of inflation. Flashcard that as an advantage. Of LIFO. So when you think about it, right, there's a distortion on the income statement for FIFO, but the balance sheet looks better. For LIFO, there's a distortion on the balance sheet because you have those old items down there, but the income statement is looking better, okay? Now, if sales exceed production, okay, LIFO is susceptible to income manipulation by intentionally reducing purchases in order to go get those lower cost items and report those as the cost of goods sold. That's a huge disadvantage. Of LIFO. Flashcard that, because think about it. Let's say I come in and I'm some sort of, you know, one of these consulting companies, and I come in and I say, yeah, well, you know, I can increase your profitability, and I just say, let's not purchase anything for a while. And so what happens? The pile starts to get knocked down, okay? And now we're down to those 425 ones that are all that is left right there. And then, you know, we sell the things for $5 and we put as the cost of goods sold 425. All of a sudden I look like some sort of consulting genius because I've got you up to, you know, 75 gross profit. I take my big bonus and, you know, take off. And now you're stuck with what? Too low of inventory levels, and you're going to have to buy those back at this prevailing price of 475 now. presumably that was the price that we had before we knocked these layers down. So, you know, that's not good. Okay, so that's why IFRS, I think the main reason IFRS said, no, we're not going to allow you to manipulate your income by what inventory method you choose. US GAAP, well, we have to keep it because we want to use it for tax purposes. Okay. Now you come on, and again, IFRS is not tested on the CPA exam, but I thought it was worth mentioning that. And then you can flash card here in periods of rising prices. LIFO results in the lower ending inventory, the higher cost of goods sold, and as we've seen, the lower net income. Okay. Okay, good. Now, let's go back to the little example of this Helix company, and let's see how things would look under the LIFO method. Okay, now for LIFO, now again, just to remember the fact pattern, they bought 9,000 units, they sold 4,000. Bought 9,000, sold 4,000, right? Same fact pattern. Ending inventory is now 5,000, but now we're going to calculate the ending inventory and the cost of goods sold using LIFO. Okay. Now what happens under the periodic system? Okay, we assume those, since they sold 4,000, those 470, that third batch with the 3,000 items, we assume we sold all those. And then we needed another 1,000. So of the next batch of the 2,000, 1,000 of those are sold. And then what? Another 1,000 are still here. Okay, we multiplied that by the 450. That gives me the 4,500. And we assume that all those 4,000 are still here. Okay, we assume we haven't sold any of those. Okay, so now when we go, we have their goods available for sale minus what we're presuming is still being in the inventory, 1,000 from batch 2, 4,000 from batch 1. We subtract that off. That gives me the cost of goods sold there. Okay, now pay close attention, guys. Okay, this is where LIFO gets interesting. Okay, so watch this closely now. Now, under perpetual, okay, I buy those 4,000. So I have to debit the inventory, credit, you know, accounts payable, cash, whatever. And since under perpetual, I have to update my inventory records after each purchase and sale, I only have one number in my system for my inventory. That's 425. So I have to use that 425. I credit inventory, I debit cost of goods sold. Then I bring in what? Another 2,000. I debit inventory, credit accounts payable, cash, whatever. And then when I sell that next 1,000, because the problem told me that the 1,000 was sold after the purchase, the second batch was purchased, I cost those out at 450 because now I have a later cost in my system. And I can use that. I credit the inventory, I debit the cost of goods sold, and then I bring in those last 3,000. I didn't sell any of those. So notice, guys, very important. Notice that you get a different answer for your cost of goods sold and your ending inventory under periodic versus perpetual for LIFO, because we use different numbers to calculate the items that we're selling when we have new cost information in our system. Okay.
Professor?
Yes.
Oh, you know what? I think this is a no, but I was gonna ask, like, is it perpetual versus periodic? Is usually one higher than the other, or is it really just depends on the individual numbers?
I mean, if you have period of rising prices, right, then for LIFO, perpetual is going to give you the bigger number, right? because you're taking items in the cost of goods sold, and as prices go up, you're taking those higher cost items into cost of goods sold, right?
Right. Okay.
So for periodic, perpetual versus periodic, if you have rising prices, perpetual is going to give you a bigger number for your cost of goods sold. Wait a minute. I mean, what did I say? Periodic is going to give you a bigger number for your cost of goods sold because you're assuming those higher price items, you sold all of them, right? Whereas under perpetual, you would be using those lower costs when those are the only cost in your system, right?
Right.
Okay. But the main takeaway here, the key takeaway here is that you get different numbers for the cost of goods sold and the ending inventory when you use periodic versus perpetual under LIFO. Under FIFO, they're the same. Okay. All right, good. Let's go ahead and let's take a look at this dollar value LIFO. Now, you might get one or two questions, okay, under dollar value LIFO. And I like the way, I think this is kind of cute, the way they write this. Under dollar value LIFO, inventory is measured in dollars and is adjusted for changing price levels, okay? And they tell us that, you have an internally computed price index, okay? Internally computed by the company. That means internally computed by you, the CPA candidate. Okay, so, when it says it's internally computed by the company and you think, okay, well, where is it? No, that's not how it works. If they say it's internally computed by the company, that means you're going to have to compute it. Okay. And so basically what you want to do is flashcard the total, right? Total ending inventory at current year cost divided by the total ending inventory at base year cost. And I put the word total because I think sometimes students want to calculate that price index just on what was added for the period. No, it's for the total. Okay. So flashcard that, and let's just go ahead and let's take a look here. Okay. And so the problem will have to give you base year, they'll have to give you current year. Okay. And then you take the total at the end of year one, okay, and you come up with an index, okay, by dividing the current year by the base year. That gives you that index, and then you multiply that by whatever was added for the period at base year, thus converting it to current year dollars. And then you would take that and multiply it by whatever the beginning was at the beginning of the period. Now, most problems will probably just have you do 1 year, but let's go ahead and let's take a look at the next year. The next year, and they have to give you what it came in at base, what it came in at current. You take the total. That's the important thing. You don't calculate the index by dividing the 26,000 by the 15 or the 15 by the 4. The 5 by the 14, it's the total, okay? That gives the index, pick up what was added at base year, at 15, multiplied by that index, that's 20,000, and then you would add that on to the beginning inventory to get what the ending is supposed to be. Okay? Now, if they give you the index, okay, then, that's fine. Then just, you don't have to calculate it. If they give it to you, you just pick up the index, which they gave us here, which was this 1.1. They tell us, that at base year, this was a little different. It was 500,000. And now it's 525 at base year. So that's that base year. That's the layer measured at base year. And so when you take that layer measured at base year, okay, you convert it using the index that they supplied, the problem supplied, and then you go ahead and you add that to the base year, and that gives you the ending inventory at current year. Okay, I don't know. I think most problems would make you calculate it, but if they give it to you, that's fine. Gross profit method, okay, and you know what they do with this gross profit method, it's a way of estimating what the amount of your ending inventory must have been, okay, because you've lost the records, there was a flood or something like that, okay. So they tell us here that they have a gross profit percentage of 20%. Their sales were 200,000, beginning inventory was 100,000, purchases were 100,000. The ending inventory got destroyed. So they're going to back into what the ending inventory must have been using this gross profit percentage. So it's sales. If gross profit percentage is 20%, then the cost complement is 80%. So cost of goods sold was 160. So you have beginning inventory plus purchases gives us goods available for sale, less what we just estimated the ending inventory to be, gives us an estimate of what the the cost of goods sold to be, gives us an estimate of the ending inventory. Okay, good. All right. Firm purchase commitment. If you have agreed to purchase inventory at a certain price, and then the value of that inventory falls, you need to take that loss. Okay, even though you haven't taken the inventory yet, you haven't received the inventory yet, if you're in a contract to purchase an inventory at a higher price and the price falls, you take that loss immediately, rule of conservatism, and you would set up a liability for that. Okay, good. With all that, let's look at a couple of multiple choice questions, which means I need to open that other file. The best way to find that is to go to full screen. There it is. Okay, now this one, this first question, guys, I want to do it together, okay? Because it's easy to get lost in this question, okay? And when you look at this one, this question one, you know, they give us a misstatement for the beginning inventory. They give us a misstatement for the ending inventory. And I think the instinct would be to try to handle both of those problems in one calculation. That's not the way to do it. The best thing is to take what is the effect, and they're asking me what is the effect of cost of goods sold for each of the misstatements that are going to be called out here, okay? So let's just look. Bren Company's beginning inventory at January 1st, year 3 was understated by 26,000. So that means that my beginning inventory, okay, was 26,000 too little, right? Now, I don't care what the purchases were. Doesn't matter. I'm just going to put X's here. But if my beginning inventory was understated by 26,000, that means what? My goods available for sale were understated by 26,000. I don't care. I know they gave me information about the ending inventory. I'm not going to worry about that right now. I don't care what they tell me the situation was with the ending inventory. When I subtract ending inventory from goods available for sale that I know is understated by 26,000, that means that what? Cost of goods sold got understated by 26,000. Okay, I'm almost there. Then they tell me that the ending inventory was overstated by 52,000. So what's going to happen? I don't care what the beginning inventory was. I don't care what the purchases were. I don't care what the goods available for sale are. Okay. But I do know that the ending inventory is what? Is 52,000 too much? 52,000, yeah. 52,000 too much. So when I subtract the ending inventory from the cost of goods sold, I subtract 52,000 too much. So that means that the cost of goods sold is going to be what? Understated by 52,000 because I subtracted too much from the goods available for sale. So I have what? I have an understatement of 78,000 going on there for cost of goods sold. Choice C. Question. I know that that seems like a long way to do this, guys, but it avoids you getting your wires crossed because notice some of the choices net them out, and that's an easy mistake to make. If you evaluate each over, understatement, whatever separately, then you kind of avoid the potential that you'll net the things out and get confused in the middle of the question and net the things out. Okay. All right. Now, question 2. I'm not going to say anything. Go ahead and do question 2. Really? Oh, there it is. That's 2 minutes, guys, and you should have been done in about a minute and a half at the most, maybe a minute. We're coming up on 3 minutes, guys. What's going on? Still got a couple people not choosing anything. Okay, I'm gonna end the poll. And would you get them on? Come on,
Yes.
what'd you get?
A.
You got A, okay. Now, when I look at A, okay, well, let me ask this. I see that nobody picked C and nobody picked D. How come?
I didn't pick those ones because I thought that it was pretty much assumed that they'd be different. They wouldn't be the same.
They
Is it-
gotta be, this is LIFO, right, in this problem, and we learned that LIFO gotta be different answers for perpetual versus periodic, so we know that those two are wrong, right? Okay. Then, to me, you pick which inventory method you like better, okay? And you're gonna come up with the answer for one or the other, and that's gonna be, have to be the correct answer, right? Okay, so when I look at this one, okay, and just about everyone got this one right, okay, sorry, Amon, I didn't mean to, now everyone knows that you picked A, but I didn't mean to call you out that way. I just want to make sure we were all working on this one, okay? But let's just take a look here, and we know that they purchased these 800, okay? And they want to know, by the way, guys, what is the what? What's the inventory at the end of that month, okay? The ending inventory. And we know that since they purchased those 28 and they're using the perpetual, we know that we have to include those $800 ones, 800 items, the $5 ones. We know those have to be in there. So we grab those. And then they sold 1,800 on 123, which means they sold all of these, right? And then they have what? They had 2,000 of those ones they got back on January 1st. They still need what? 600 to fill that order. So that means there's only what? 1,400 of those left. And so you go ahead and you take that 1,400 times the dollar. And so when you do the math on that, what's that? 4,000 for those and 1,400 for those. That's how you get the 5,400. And that's how you know that what? B is correct. Okay. Now you could have done periodic. Okay. You don't, I mean, just for fun, we're going to do periodic. You could have started with periodic on the exam. You wouldn't have to because you know it's either A or B at that point, and it's got to be B now, right? But let's just go ahead and let's think about how we would do this for periodic. So the beginning inventory in this example is $2,000, right? And then we have purchases. And the purchases are what? Are 3,600 and then 4,000. So the purchases are 7,600, which means goods available for sale are 9,600. We know that, okay? Then we would go ahead and say, okay, well, what is the ending inventory, which the question wants to know? That's the unknown here. But we can figure out the cost of goods sold, right? And we know that under the periodic system now, they would have gone ahead and assumed that they sold all of those $5 ones. That would be $4,000. And they still need what? They still need 1,000 of these $3 ones to make up the total of 1,800. So that's 3,000. So that means that the cost of goods sold is 7,000. Well, if the cost of goods sold is 7,000, then you would take 9,600 minus the 7,000, means that the ending inventory must be what? Must be this 2,600. Which we knew that was the answer because we knew that 5,400 was the right answer for the perpetual. Question. Okay, good. So I think that is a good breaking point. If there's no question, we can go ahead and come back and we'll start talking about property, plant, and equipment. I'm showing pretty close to 6:30, 6:26. I always get some weird time. Let's just go ahead and make it 6:40. We'll come back, okay?
Okay, thank you.
I'm gonna pause the recording and I'll start it up again when we get back. Someone remind me if I forget. Go ahead and resume the recording. And let's take a look at property, plant, and equipment, okay? And the thing that we're going to see is that we're going to carry property, plant, and equipment at historical cost unless, again, there's been some sort of impairment, the value of that inventory has fallen, not inventory, but now fixed asset has fallen, then we'll go ahead and we'll have to recognize the impairment for that, and we'll look at that. Now, when we talk about, you know, property, plant, and equipment, I think you know that that includes land, buildings, equipment, that sort of thing, okay? And of course, we have the accumulated depreciation, which is a contra asset account, right? And we're going to look at some depreciation methods as we go through. Now, one of the things that the exam loves to ask about, and I find it wonderful that they ask this because it's the easiest thing in the world, okay? How do you evaluate the cost of the land versus the cost of the land improvements, including buildings and whatnot? And I find these questions very easy. I mean, it's an important thing in accounting because we don't depreciate land, we depreciate land improvements, right? So we need to be able to separate that out. But from a CPA exam question standpoint, this is easy stuff, okay? So the cost of the land, okay, is basically any cost you have to incur to get the land nice and flat so you can begin excavation for the foundation of the building and whatnot, okay? Now, I'm going to give you a passkey. I'm going to show you a passkey that's in the book here in a couple of minutes for that. But there's a couple of things that are listed here that I do want you to flashcard. The cost to tear down an old building, okay, tearing down an old building, that's part of the cost of the land, okay? And then if you can sell whatever scrap metal you might have, whatever, from that building that was torn down, that would come off of the cost of the land, okay? Now, once you have that land nice and flat and you begin to excavate to build whatever the building is or whatever, make land improvements, those get capitalized, okay? So even things like fences, water systems, landscaping is something that would be capitalized and then would be depreciated, okay? We'll talk about interest costs later, but you come over and when we talk about cost of the building, cost of the plant now, obviously the purchase price. Repairs that have been neglected by the previous owner, okay? So you have to come in and get all kinds of dry rot cleaned up and stuff. That's part of the cost of the building, okay? Alterations, improvements, architect fees. We'll talk about interest later, okay? So what I want you to do is just make a flashcard here. And this is a nice visual, okay? Any money that you pay to, fill in a hole, level the land so you can begin building on it, draining of swamps, all that kind of stuff. That's part of the cost of the land. Once you start to excavate, dig a hole, that's part of the cost of the plant. Okay. Now, we also have this notion of basket purchase for land in building, and they tell us to allocate the purchase price based on the ratio of appraised values to the individual items. Okay, so what happens? Let's say I pay $500,000 for land plus building. Okay, and I want to know, well, how much of that 500,000 should go to the land, how much should go for the building? Because I'm going to depreciate the building, I'm not going to depreciate the land. So it's an important accounting question. CPA exam questions are pretty easy here. They might tell you that the appraised value, easy for me to say, the appraised value of the land, let's say, is 100,000. The appraised value of the building is, say, 300,000. Now, what they probably were doing here is they were appraising the building as though it wasn't on that land, and they're appraising the land as though it didn't have that building. Put the two together, then somebody's willing to pay more for that, right? Okay, than you would each one individually. And so what happens now, I think you can see where this is going. We would take the 500,000, and for the building, we're going to take 300,000 divided by 400,000, or 75%. And that's going to go, what's that come to? 375,000. That's going to go for the building. And then for the land, we would take the 500,000 and multiply that times 100,000 divided by 400,000, or 25%. And I think that comes in 125,000. Okay, so you'll see questions like that, and that's how you do that. And that's pretty straightforward, pretty fun, actually kind of fun problems to work. Okay, now cost of equipment. Okay, and it includes all expenditures related to acquisition, construction of the equipment. For example, okay, freight in, right? We said freight in. Any money you pay to get an asset so you can use it in your business is part of the cost of that equipment. Okay, installation charges, sales and federal excise tax. I had a student one time who I guess was getting some pushback at work because she wanted to capitalize. When you buy a computer, they make you pay that disposal fee for the computer. And she wanted to capitalize that, and they were saying no, and she was right. You should capitalize that. If you have to pay money to take an asset out of a store, that's part of the cost of that asset. Okay, the sales tax, everything. Okay, now when you take a look, and we have additions, okay, and additions should be capitalized. By capitalize, we mean what? Debit asset, credit cash, accounts payable, whatever. Improvements and replacements should be capitalized. Okay. Now, when we look at this, if you're going to have improvement, you're going to have a replacement, you may not know the carrying value of the thing that you're replacing. Okay. For example, I buy a building. The building has a roof on it. Then I have to remove the old roof and replace it with a new roof. Well, what's the value of the old roof? I probably don't know because the roof was on the building when I bought it, right? And so what happens? If the value, I probably didn't set that up the best. If the value of the old asset is known, remove the value of the old asset and capitalize whatever you spent for the new asset. More to the roof example, if the carrying value of the old asset is unknown and the asset's life is extended, which I think would probably be the case if you're just putting a new roof on a building, you've probably extended the life, then debit the accumulated depreciation and credit the cash or accounts payable for whatever you paid to replace that roof, okay? If the usefulness of the asset, then go ahead and capitalize that directly to the equipment account. And you can go ahead and flashcard those rules. For example, let's say you overhaul the engine in a vehicle, and now because you've overhauled the engine, it can make longer distance deliveries. So you've enhanced the usefulness of that asset. You would probably go ahead and want to capitalize the asset account for that. Okay, flashcard that. When we talk about repairs, if it's an ordinary repair, then what? Ordinary repair should be expensed. Extraordinary repairs should be capitalized. So if you're just, changing the tires, okay, that's probably an ordinary repair. If you're overhauling the engine on a vehicle, that's probably an extraordinary repair and should be capitalized. So flashcard that. Okay. All right, pretty straightforward stuff, guys. There's nothing terribly complicated, okay? Now, you come over and we start to talk about capitalization of interest, okay? Now, what happens? When we are capitalizing interest, okay, we will capitalize interest using something called the weighted average of accumulated expenditures, okay? And we do this for items that we are constructing for ourselves or for others, fixed assets intended for sale, okay, land improvements, all of these things, okay? You're going to build a cruise ship. You're going to borrow the money to build that cruise ship, okay? Now, what you'll do is you will, and the problem will either give you the weighted average of accumulated expenditures, or it will make you calculate it, okay? So you're going to take the weighted average of accumulated expenditures, and then you're going to apply an interest rate to that weighted average of accumulated expenditures. Now, let's just get an example as to how to calculate it here, since for some reason the book doesn't really give us one as to how to calculate it if we have to. So let's say that on January 1, company spends $1 million on some project that they're going to be borrowing money for. Okay, they're building a cruise ship, whatever. Okay, and then say that on September 1, company spends another, and let's say now they spend another 500,000. Now, to get the weighted average of accumulated expenditures, right, what you would do is you take the million times 8/12. Count on your fingers for those, guys. Don't include September. Don't count September, because September we spent that money September 1st. So the million was outstanding for 8/12 of the year. So that gives me the 6,666,667. And then the 500,000, okay, I'm going, excuse me, that additional 500,000 now that they spent. One second, guys. that extra 500,000 they spent, okay? Now that means we have what? We have 1,500,000 that was outstanding for what? Outstanding for 4/12. That gives me 500,000. When I do the math on that, I add that up, and the weighted average of accumulated expenditures is 1,166,667. Okay, that's how you would calculate the weighted average of accumulated expenditures. You're going to sit there and see how much was outstanding for what fraction of the year. That first million was only outstanding for 8/12. You added another 5, so you had 1.5 million outstanding for 4/12. And that's how you would calculate the weighted average of accumulated expenditures. Then they say that you have to apply an interest rate to that weighted average of accumulated expenditures. And the interest rate, like, well, where am I supposed to get the interest rate? The problem will give that to you. By the way, flashcard that you have to do the weighted average of accumulated expenditures. They may give it to you, but then the interest that you use, and the problem will give it to you, and it's the interest for the specific borrowing, okay? So it's for the specific new borrowing, and the problem will tell you they borrowed money for this project, and here's the interest rate on that borrowing, okay? So flashcard that green part. Now, what happens if the weighted average of accumulated expenditures is more than the amount that they borrow? Well, you're going to want to capitalize that additional amount. Okay, so if the weighted average of accumulated expenditure exceeds the amount of the related specific new borrowing, interest costs should be computed on the excess, and the interest rate that should be used will be the average interest rate of all other borrowings of the company. So when you look at that, the problem would have to give you 2 interest rates in that situation so that you can capitalize the interest on amounts of weighted average of accumulated expenditures that exceed the specific borrowing for that project. Okay, you cannot capitalize any interest in excess of your actual interest expense. So you're always capped by your actual interest expense. Now you look at this, guys, and what? Flashcard. I mean, the new FAR exam doesn't quite get into just, really complicated sets of rules. I think the most complicated set of rules we've gone through up until now had been the way to calculate fully diluted and primary earnings per share. When we have that kind of stuff, then we have to do these flashcards like this. Okay, flashcard these, but I think what you'll see is that as you start to take a look, okay, at an example of a problem, it's not that bad. Okay, so let's just take a look. January 1st, they have a contract to build a kitchen for $1 million. They borrowed $500,000. Okay, we have to pay back the loan, and I'm looking at a problem. I'm pretty sure I'm going to have to use that interest rate because I have to use the interest rate on the borrowing for the project. Convisor plan to finance the balance of the construction cost using the company's existing debt, which had an average interest rate of 9%. There's a second interest rate because we're going to have what? We're going to have weighted average of accumulated expenditures in excess of the borrowing. And so sure enough, that's what happens here. They had accumulated expenditures of 600,000. They tell me what the actual interest cost is because I can't capitalize more than that. So I take what? The 500,000 times the interest rate on that borrowing. I got to capitalize that. And then for the excess, right, the 600,000 was the weighted average of accumulated expenditure minus the 500,000 borrowing. That extra 100,000 is going to use that what? 9% rate. And so that's 9,000. I'll capitalize 64,000. I'm good to go because my actual interest cost was 150,000, so I didn't overcapitalize. Okay, Now, sometimes the problem will get cute and, they'll say, well, they're thinking about building a building and they borrowed some money. You have to have construction expenditures for the assets are being made, blueprints, that sort of thing. If they're just sitting around and they borrowed some money and they're thinking about doing something, or they stop building because they say, hey, we're going to wait for the market to improve, you stop capitalizing interest. Okay, so activities have to be going on. Interest has to be incurred. If there are intentional delays, then you stop. If it's an unintentional delay because you've got poor weather or something, that doesn't stop. And then it ends when the asset is ready for the intended use. And so once you've built those, say if you're building a condo and you're sitting there and now no one's buying the condos. Well, you're not constructing anymore. You're just waiting for someone to come along and buy those. So you stop capitalizing that interest at that point in time. Okay. Okay, good. So flashcard those as reminders. And then finally, what the disclosures are. I typically ask you to flashcard disclosures. A lot of flashcards there, guys. A lot of rules, a lot of flashcards, but I think you'll see that the problems aren't that difficult with these. Okay. Okay, good. Now let's come over and let's look at a couple questions. Don't know why I'm doing it like this. I should do it in full screen. Here we go. Okay. All right, I'll put the poll up. Okay, guys, I'm not sure why everyone isn't finished with this one. And I'm a little surprised that we didn't get a, 80-90% accuracy rate on this one, because I don't think the questions get much easier than this on the exam. Okay, but let's go ahead and take a look here. The answer is A, but we have what, 400,000 that we paid. Demolition of old building? Yep, that's part of the cost of the building. I mean, excuse me, part of the cost of the land. Legal fees to purchase it? Yep. Any cost you have to incur to get this thing ready for its intended use, part of the cost. Title guarantee insurance? Yep. Proceeds from the salvage of that tearing down the old building, that's money that comes in, that comes off the cost of the land, and then that gives you the 464,000. Question on that? I'm not sure why that was difficult. Okay, all right, let's go ahead then and let's take a look at another question. What's going on, guys? I've got about 4 people that are checking out here. Don't make me start calling names. Okay, all right, we're about 2.5 minutes now. So let's just go ahead and end the poll. Let's take a look at this one. Most of us that tried it got it right. Okay, but there are a few of us that are for some reason sitting on the sidelines. Okay, but we'll get you at some point or another. Okay, but what happens? On January 2nd, they spent $1 million. Okay, we want to come up with the amount that should be capitalized. So we got to come up with that weighted average of cumulative expenditures. So they had the $1 million. They spent it. Okay. And then they go and on December 31st, they spend another $1 million. Okay. So that's a total of 2 million. But the total of 2 million was outstanding for what? 0/12. It wasn't until December 31st. So that means that what? That first $1 million was all that was outstanding, and it was outstanding for the entire year. So the weighted average of accumulated expenditures is $1 million times, and then the problem gets pretty easy because you know you got to pick up the interest rate on the specific new borrowing times the 0.08%. And would that give us 80,000? Okay, I think somebody picked D, and I think what happened was I'm not sure what you did because I mean, if you were gonna do 2 million, then it should only have been 2 million times 1/12 if you didn't realize that it was December 31st. But anyway, I'm not sure why you would add the 2 millions. You gotta weighted average. So you have to weight it by how long it's outstanding. That's why D was wrong. Okay. Or what was it? Somebody pick the 3 million? I see. If you pick well, actually, that's a good point. The 3 million times the 8% is 240. That would be our cap. We can't capitalize more than that. That's where the 240 comes in. You're capped at what? You're capped at 240, but we were only at 80, so we're okay. So maybe that's where they got the 240. You would use that 240 to make sure you hadn't capitalized too much, but it's not the right answer. Okay, good. Let's come over then and let's start to take a look back at the new book. And let's start to take a look at depreciation methods. Okay. Now, guys, at this point, I think if you've gotten this far in your study of accounting, okay, you know things like the salvage value will be subtracted off the cost of the asset, okay, in the calculations, okay, and then the estimated useful life will be used as the period of time that we're going to use to calculate the depreciation. So I'm not going to belabor that stuff. I think you know that, okay. Now, we do have component depreciation versus composite depreciation, okay? With component depreciation, we'll depreciate each part of the plant as an item of property, plant, and equipment. For example, for the building, foundation, and whatnot, 30 years. For the roof, 15. For, the other pieces of the building, a different depreciation schedule, whatever. We go by item by item. Okay. Composite depreciation, we're going to depreciate the entire building, say over 30 years. Okay. Now, there's also something called group depreciation. Okay. And with group depreciation, okay, what we do is we depreciate assets in an entire group. Okay. Now, under group depreciation, okay, if the average service life of the group of assets has not been reached and the asset is retired, the gain and loss that results is absorbed in the accumulated depreciation account. And this is one of the few times in accounting that I would say, yeah, it's a plug. You're going to have to do a plug for this. Okay. So what happens? You take a look and they're depreciating these items as a group. Okay. And you take a look, you have the machine A, the salvage value, machine B, and so on, the estimated life. Okay. Then what? Then you take the depreciable base, and that's divided by 45,000. So this asset has, we're going to basically be depreciating this item over 16 years is its life that we're coming up with, because the annual depreciation is 45,000. So it's over 16 years. Now, the important thing here is when you sell one of the machines, and say that they sell one of the machines, machine A, for 260. Okay. Of course, you're going to debit cash 260. You're going to get rid of asset A at its cost, the 550. And instead of debiting, calculating a gain or loss on that, you will simply plug the amount that goes to accumulated depreciation. It all goes against the accumulated depreciation. So just plug that number. Okay. That's a true plug. It's just whatever number you need to make that journal entry balance. Okay. Now, depreciation methods. Straight line, guys. If you've gotten this far, I think you know how to do straight line. But if you somehow don't, flashcard that. Okay. And the key thing with depreciation questions is be careful. Make sure, okay, I'm going to put a couple stars next to that. Make sure that you know when the asset was put into use in the problem, because it is very easy mistake to make, to take a full year's of depreciation. Meanwhile, they tell you the asset was placed in service July 1st. You should only take a half a year, right? Okay, so be careful with that. That's an easy mistake to make. And they'll often put the full year's depreciation as the first choice, choice A, in the A position. The CPA exam doesn't have letters, but they'll put it as the first choice because they know you're nervous, you're in a hurry, and that's an easy mistake to make. Okay, so don't fall into that trap. Okay. Sum of years digits, okay, I don't know that this is used very much these days anymore, but it is still tested on the exam, okay? But what you would do is you would add it, the digits, and then if you were saying an asset with a 5-year life, in year 1, you would take 5/15. Year 2, 4/15. Year 3, 3/15. Year 4, 2/15, and then year 5, you would take 1/15. And whoever thought of this depreciation method had way too much time on their hands, because at the end you would have taken all 15/15 of the depreciable base. Now, notice the depreciable base is still just like it was for straight line cost minus salvage value, but now you're going to go ahead and figure out, in year 1, take 5/15, year 2, 4/15, and so on. Okay. Now, flashcard this, because I don't want you to get stuck on the exam where it's a 50-year life, and all of a sudden you have 1 + 2 + 3 + 47. Oh, did I say 48? Let me start over again. Okay, so I don't think the exam will get into much longer, like they say here, than a 4-year life. So maybe 5 years. And so, you probably won't have to use that little formula, but have it available, okay, in your head. Okay, now, we still take the depreciable base, just like we do for straight line. And if it was a 4-year life, 4/10 the first year, 3/10 the second year, and so on. What if the problem asks you, what is the carrying value of the asset at the end of year 2? What would you say? Carrying value of the asset at the end of year 2. That's a question. I'm asking you a question. What is
7,000? 7,000?
Good, excellent, Mike, because I wanted to make sure that we realize, because it's an easy mistake to make. If they ask you the carrying value, it's the cost minus what, and we would have had accumulated depreciation of 7,000 at the end of the 2 years. Good. And that gives me 4,000. Thank you. Okay, very good. Yeah, because it's an easy mistake to make, to take the 10,000 minus the minus the 7 and say 3,000. No, it's 11,000 minus the 7,000. Good. Okay. Okay, good. Come over, and units of production. This is a pretty smart way to take depreciation. Notice, guys, you still have cost minus salvage value, but now you divide it by the estimated units that you can produce with this machine, or the hours that it's going to be used. That gives you a rate per unit or hour, and then you simply take that rate per unit or hour and multiply it by the number of hours worked, the number of units produced. That's your depreciation expense. Okay, a little tougher record keeping for companies, because now they have to track the hours or units or whatever. And so most companies, by the way, these days will use straight line. Okay, that's still the case because it's accepted and it's pretty straightforward. No pun intended. Now, when we look at declining balance, okay, and the most common is double declining balance, but it doesn't have to be double declining. It could be triple declining. It could be 1.5 times, okay? But basically what you do is you take the straight line, and if it's double, you double the straight line. If it's triple declining balance, you triple the straight line, Okay, now very important. In the calculation, you do not use salvage value. Do not use the salvage value in the calculation. However, do not depreciate below salvage value. So you're going to kind of write the salvage value off to the side and keep your eye on it and make sure you don't depreciate below the salvage value. Okay. Now let's just go ahead and take a look at this example. They paid 10,000. Yes. Is there a question? They paid 10,000 for this thing. It has a what? 10-year life. 1 divided by 10 would be 10%. Double that is what? 20%. Okay. So 20% times 10,000, they'll take 2,000 the first year. You take that 10,000 minus the 2,000, and now the declining balance that's left is what? 8,000. Okay. 8,000 times the 20% gives me 1,600. I take that 1,600 off. Now I've got what? Now I've got 64 times 20% and so on. I'm not going to go through the whole table. I don't want you to go into a coma on me here, but notice that in this last year, if they, not this last, year 8 here, notice that if they had taken the 2,098 and multiplied that by 20%, I think they would have come up with something like $419 or something. And if they took that 419, that would bring them down below the salvage value. No, you just take 98 that last year and you stop at that salvage value. Okay. Again, for all the methods, guys, if you put the asset in use, a portion of the year, only take a portion. Don't take full year depreciation. The only time you take the full depreciation, I guess, is if you were using the units of activity method, whatever, units of production method, then it's whatever you produced for the time you had it. But for these other methods, you always take a fraction of the year if you put that asset into use partially in the year. So I think we told you that like 3 different times. Don't make that mistake. Okay. It's an easy one to make. Okay, good. Let's talk about depletion. Okay, now depletion is basically we're paying for a piece of land, not for what we can put on top of it or how we can use it, but for what we can pull out from underneath the land. Okay, so when you look at this, I want you to start over here. And I want you to make a flashcard as to how to calculate the depletion base. So whatever it costs you to purchase the property, okay, plus any development costs. What happens? If I'm going to be extracting coal from the land, I can't put a vacuum cleaner on the top of the land and pull it out. I have to use shafts and whatnot to get the people down there so that they can start mining the coal. Well, I would add that to the cost of the land. Sometimes they get stuck down there and stuff. Okay, so I got to get them down there and I got to get them out, so I would have to use that, add that to the cost of the land. Any estimated restoration costs, the federal government has the Office of Surface Mining in the federal government is the agency that's responsible for making sure that after a coal miner or something is taking all the coal out of the ground, that they restore it. They have to put a park there or something. And then maybe they're going to put a condo development on top of it. Okay, so they could then sell that back to a condo developer. Then that would come off of that base. Okay, so you have all of that. That gives me the depletion base. And then I simply divide that by the number of recoverable units, and the problem will give that to me. What are the number of recoverable units? Once I do that, that gives me a unit depletion rate. And then I simply do what? You can flashcard that. To come up with the depletion, I simply multiply the unit depletion rate by the number of units that have actually been just extracted. That tells me what I have as my depletion for the period. And then if all the units extracted are not sold, the depletion must be allocated between cost of goods sold and inventory. Flashcard that. Okay. Now, let's just look at this example problem, and this is pretty good. Okay, I'm not going to read through all those details up there, but we have the cost of land. Right here is this 3,400,000. Okay. We have the development cost. Apparently, there were no restoration costs. And by the way, that Office of Surface Mining does not do a very good job of getting them to fix stuff after they, tear up the land, taking the coal out or whatever. Because I was on an assignment where the finding that I had was that they needed to improve their processes tremendously because they had a bad record for getting money out of people that screwed up the environment, taking coal out of the ground or something, and then getting them to fix it up afterwards. They were not very good at. Anyway, beyond the scope of what we're talking about, obviously. And then any residual value would be subtracted off. That gives us the depletion base. Okay, there it is. And then the problem would tell you, hey, they think they can get 4 million tons out of that. So that's $1 per ton. If they wanted the total amount that was extracted, dollar amount is 4 million. And then if you had to allocate it to cost of goods sold, it would be the number of units sold that the problem told us times that depletion rate. And then since they extracted 400,000 and they sold 375, the ending inventory would be 25,000. I don't know that you need that passkey for that. Okay. I had you flashcard the elements that go into it. I don't like necessarily using mnemonics for stuff like that. Okay. All right, good. So with that, let's get out of this. Go back to the version of the text where they have the problems. But is yeah, okay, this is the one we want. Okay, let me put the poll up.
Question for you. This is the first time I've seen it called 200% decline in balance. Is that common come down the favor, I've seen that for the double declining.
Okay, we're a little over 2 minutes here. Looks like most folks have had a chance to try this one. So, good. Most of us got this one correct. And let's go ahead and take a look. And in this particular problem, they're asking us to use the car uses 200% declining balance, which is double declining balance. Fancy way of saying a lot, you know. Why they have to say 200% declining balance? Why can't they just say double declining balance? But whatever, what are we going to do? Okay, so what happens? So we have this 100,000. And since it's a 10-year, okay, that means it's 1/10 or 10%. 10% times 2 means it's what? 20%. Okay, so we take that 100,000 times the 20%. That means we take 20,000 that first year, 100,000 minus that 20,000 means we have a declining balance available for year 2 of 80,000, and they wanted to know for year 2. So I take 20% of that, and that gives me 16,000 for year 2. And we would keep going like that, making sure that we don't depreciate below the salvage value, which they gave us that, but it wasn't, that salvage value was there to see if you would make the mistake of using it in the calculations. No, but you don't depreciate below the salvage value. Okay, all right, good. Let's take a look at this one. Okay, guys, we're coming up on 3 minutes in this question. I'm not sure. I got 8 people responding. I'm not sure what everybody's doing here. I'm gonna start holding you a little more accountable to make sure you're working through these, because we spend time in here working towards the goal of being good at working CPA exam questions, right? Okay, but let's go ahead and let's take a look at this one. Most of us got it right. The answer here is B. So let's go through and let's just kind of see how we would have had to pick out some of the numbers here. Now, they purchased the mine for 2 million. Okay. 640,000. Well, I know that's got to be part of the depletion base, right? Okay. And then it has removable ore of 1,200,000. I'm going to write that over here. I know I got to use that number, but I'm going to wait for a second before I put it into my, well, I guess I'll write it down here. 1,200,000. I know that's going to be the denominator on this calculation of the amount per ton here, right? So it's 1,200,000 tons. And then they'll be required by law to restore the land at a cost of 180. Yep, got to pick that up. Okay. And even though, don't take, if you left that out, don't take the fact that the government doesn't do a good job getting that done. That doesn't mean you don't add it on there. 180,000. Never mind. I'm not going to talk about that assignment anymore because it gives me bad memories. Then we keep going. It says Boris believes that he'll be able to sell the property afterward for 300,000. Well, if that's the case, I'm subtracting that. And then during the year, Boris incurred 360,000 of development costs. Yep, got to pick that up. So this was one of those problems that you used everything, right? Unlike a lot of CPA exam questions, you got to know what to avoid, right? And so when I do this, I get an amount per ton. I divide the 2 million. Let me just write that. 2,880,000 is the sum of those numbers divided by the 1,200,000. That gives me a cost here of 240 per ton. Now, in this problem, they tell me that they removed and sold 60,000 tons. And what should they report on the income statement as depletion? And by the way, guys, I'm thinking that the depletion would be the cost of goods sold, right? So we have whatever we sold it for minus the depletion cost is like the cost of goods sold. And then I probably report a gross profit and then start talking about different selling and administrative expenses from there on this, whatever the name of this company is, Vorst's income statement. But since they sold it, I don't have to worry about, seeing how much should be inventory because they extracted and sold 60,000 times the 240, right? Gives me 144,000. Okay. All right, not too bad. Let's see what we have left here for chapter 3. Oh, okay, impairment. Let me see. And then we won't get to intangibles. Okay, so what I had planned for the impairment. Okay, let's just do it here. I wish they would have done this differently, but let's just look at it here. Okay, so what we do for impairment of our fixed assets, we look at the cash flows that are going to be generated from this asset, and those are undiscounted cash flows. Okay, we subtract that from that, the net carrying value of the asset, If the number is positive, you stop. Okay, so let's say the undiscounted cash flows are $1 million and the carrying value of the asset is 950. That's a positive number. You don't calculate any impairment. Okay, now let's say that the undiscounted cash flows were 950. And let's say the carrying value was $1 million. Well, now we have carrying value more than what we think we're going to recover on an undiscounted basis. We've got a negative number of 50,000. So at that point, we would go ahead and we would keep going in the calculation of the impairment. Okay. Now, what we would do at that point is we would discount the cash flows. You would take the present value. Now you take the discounted cash flow, you discount those cash flows. And let's say when we discounted the cash flows, let's say that the discounted cash flows, undiscounted, they were 950. Let's say discounted cash flows are 700,000. I'm just making that number up. Net carrying value of the asset at this point is what? Is $1 million. So I would have impairment loss of what? 300,000. I would write the asset down. If the asset's held for use, I'd write it down. I would depreciate the new cost and restoration is not permitted. If I am disposing of the asset, this part is exactly the same, but now I'd have to figure out what are any cost of disposal. That would give me my total impairment loss. I write it down. I no longer depreciate the asset because I'm disposing of it. And I can write it back up, but I can't write it back up past, in this example, the 950,000 that it was being carried at before I started calculating these impairments. Okay. Okay. Question. All right, guys, we're going to stop there. We will pick up with module 6 next time, and then we will get into chapter 5. Excuse me, chapter 4 next time. Okay.
Professor,
Mhm.
I was looking on our page. Is there a place other than the weeks where you were posting your videos, your recordings?
No, I haven't been posting them because nobody asked me.
Oh, now that
Want 'em? If you want them, I'll post them. I just haven't been posting them because there didn't seem to be any demand, and it's somewhat of a little bit of a process I have to go through. But if you want them, I can post them.
if it's not too much trouble, because I just got my book, so I'm kind of bouncing in between the notes I've been taking and my books, and I would love to review them to see if I've missed anything. So if it's not too much
No, it's just a little bit of a process, and I guess I got a little lazy and nobody was asking for them, so I thought, well, nobody wants them, fine. But it's fine. I can post them.
I thank you so much.
Yep. Anything else, guys? Mike?
Yes, Professor. It's about the last time we have a talk after before ending class. So yeah,
Yeah.
I already have contact with Alexa, and somehow she has responded back, and she's asking something. If we are going to do the CPA evolution event on November 14th, she's asking like if they Mos Adams has to bring something from the firm
No.
just to like add some. No?
No, I mean we want them to come and talk about their firm, recruiting process
Okay.
stuff. That would be the front part of the presentation. You're talking to the guy that knows about the CPA evolution. Between Alex and I, we got it from the CGU. There's no one at Moss Adams that knows more about it than we do. So we'll after they're done, then I'll step up and I'll do the discussion about the evolution.
Okay, I know
it'll
how,
be-
yeah,
It'll be good for the class too to come. I'll offer extra credit to Counting 377 to attend that, because I will be talking about how many questions in each module and stuff. And so that might be helpful, each testlet. So that might be helpful to the class too, to come to that.
yeah, okay.
That'll be during
That should do it.
November 18th, whatever. What is it? November
14 for the, yeah.
Yeah. November.
And okay, I was thinking to host this event on at 3 p.m. So like we can have like an hour for the event, and after that, like have like a 1 hour too before we start class to like have Q&A or making some networking with the Moss Adams staff that will be present on the day of the event. So what do you say, Professor?
Yeah, sure. I mean, if that's the case, maybe I go first and they go second, because I would think they may not want to be hanging around to hear me talk. Moss Adams folks. So we start at 3, I would go first, then Moss would come in, and then, they could be a little mixer afterwards, for about a half hour or so, and then we start. But I want it to be in our classroom. I don't want
Yeah,
to.
the classroom is 4209 or 4204.
I don't know.
I'm
It's on the syllabus. I'm not sure.
guys, can you help me with that? I don't remember the room number. I just
It's 4204.
Oh, 4204. Okay, thank you very much with that help. Yeah. Okay. So,
Okay.
by the way, Professor, do you have any preference who's coming from Moss Adams?
No, no,
No?
no.
Okay.
Whoever they want to send, that's up to them. No,
Okay, that's good. That's good.
I
That's
mean,
good for
it's
me.
kind of good if they can send a GTU alum, but whatever, that's not necessary. But that's okay. No, let's stick with the short answer now. Yeah,
Okay,
but let them
thank
know
you, Professor.
for
So,
that. They don't have to speak to evolution. I'll do that. We want them to speak to their area, which is what their firm's all about.
what their firms?
Yeah.
Okay.
Did you guys see also Moss Adams is going to have
Oh,
visit?
Oh, Professor, I just want to mention something. That was a great idea and a great invitation that you just sent us. If we have the time to attend for office tour, but the Silicon Valley office. And then I just got this same idea for Alexa, and she's more like in to help and assist to make that office tour happens too in the San Francisco office.
Okay, that's fine.
So I'm thinking, can we, like, if anybody who can attend for the Silicon Valley for the extra credit, they can do it, and
I'll give you
if they can
2
also,
extra credit opportunities.
okay, that is great to know. Thank you,
Yeah.
Professor.
What it's annoying is that the other GGU professors don't do this. I find that annoying because I feel that we should reward our students for thinking about their career, getting involved in the profession, etc. And I meet with resistance when I suggest that everybody give extra credit to do these things. I don't get it. I mean, what are we here for? We're here to, help you to, get a job at the end, So, I mean, come on. But anyway, I mean, to me, this class is the one that has the most practical application outside of getting a job, that you're going to be passing the CPA exam when you're done. I mean, all these other classes, anyway, let me stop. Let me shut up. I'm going to have to edit that out.
Okay. That is
Okay.
great. So
Before you get me in
Okay,
trouble, anything else, Mike?
no, it's okay. It's okay already. I will be copying you with the
Yeah.
my confirmation to
Get back to them.
Alexa.
tell them the way we're
Uh-huh.
structuring it. They're more than welcome to come at 3 o'clock. Tell them we're gonna talk about the CPA exam first.
Mhm.
And they come second, just in case they don't want to stay for that part. Because we want to have a mixer at the end, you know, a little chance to mingle, not a mixer, but a chance to mingle at the end.
Yeah, and they should not be worried about the food or beverage, because somehow I will be also applying for a budget, so you guys can have fun and have some food and beverage. So they
Yeah.
don't need to be worried about that, the firm. So
Um,
the only thing that they just need to is to be present a staff from the Moss Adams to, well, explain how the industry in Moss Adams works and all those stuff.
yeah.
Mhm.
Okay. We have a young CPA come CPA here, I see.
Yeah.
Draws all over my notes sometimes if I'm not looking.
Okay.
So Mike, this event is going to be on November 14th, you said?
Yeah, about the CPA evolution would be
Yeah.
on the November 14th. That is the upcoming campus week.
Yeah, okay.
When we're scheduled to be in class.
Yes, yes.
Yeah.
Got it.
Mhm.
So you'll come to class at the scheduled time, but if you want to come earlier, then I guess I'll give points for that too. I'll give you 5 points for that one. I'll give you 10 points for anything you show up to. How about that? Screw it.
Sounds good.
That is good for you guys. That is
Yeah.
good for you guys because, well,
Professor, I have already enrolled for the session which is coming up on November 3rd for
Oh, good.
Silicon Valley. But do we have to submit anything to you? Like, how do you know that we have?
They're gonna tell me.
Okay, got it. Okay.
Yeah, you might want to take a selfie while you're there, just in case. But you know, no, I'm serious. You know, because it's always good to have something. No, they said I wasn't there, but here I am. Did the thing, you know. But they're supposed to give me something.
Okay, got it.
wow. How are you going to travel from the place you are, Bharati? Because somehow from mine, it takes quite a time.
I think Campbell, it's going to take an 45 minutes to 50 minutes drive from me. It's not that bad.
Whoa.
Some folks are
Okay.
down there too. I think some of our class members are down there, so they might actually like that better.
I think 1 hour drive, not more than that. I think it's okay. For
Yeah.
1 day, it's fine.
Yeah. Okay, guys, good work.
Okay.
We'll see you next week.
Yep.
Keep up the good work.
Good night, Professor. Thank
Okay.
you.
Good night,
night,
Professor. Thank
you.
you.
Thank
Bye-bye,
you. Good
guys.
night.
Good night.
Thank you so much.
Bye.